In this video, we'll revisit the 5 observations that we made about the current market volatility in last weekend's video. We'll observe how these patterns repeat themselves once again over the course of this previous week. And similar to how our last weekend video was, we'll study Thursday and Friday's activity in particular, with each of these lessons in mind, to continue to do the same sort of weekend homework, gather new observations to keep dominating the markets this upcoming week. Stay tuned to learn more. Let's start with the first observation, which is around the idea that the Nasdaq is the market that tends to move the most on a pure percentage basis. And we talked about how it should really be called the Nas-crack, right? So now if we take a look at the actual charts, here we have the charts for Friday morning, and in particular, we're trying to pay attention to the 7 a.m. to the 8 a.m. Hours across the board, right? And so let's just highlight that out so we know where we're trying to focus. And in particular, what we'd like to see is the fact that the Nasdaq breached our volatility box right here, but the S&P did not, the Dow did not, and the Russell didn't come even close to it. And that was our first sign that the Nasdaq market is moving a little bit stronger than any of our other markets, right? Typically, so far, what we've seen with this current volatility is the Dow is the first market to hit either the clouds, and that's typically based off of the catalyst being the coronavirus, at least as of recently, or some sort of China news, right? Now, in this case, we see that the Nasdaq is our first market that triggered and didn't actually give us the follow through we were looking for. Instead, it ended up going to the next volatility box level, stopping you out of this first trade and then giving you a second entry. But at this point, we're on our conservative volatility box, right? So that's all information right here, which is the fact that the Nasdaq market's the only market that actually triggered an entry, whereas our other 3 markets didn't come close to triggering an entry. So that's information. This weird phenomenon, right? It's the reverse of what typically happens, which is the Dow triggers. Now let's take this one step further, which is load in our gold market, which was another observation we talked about, which is gold has been really our safe haven, where when the indices are being a little funky, gold has been a little bit more predictable, a little bit more contained, and we've found some really nice trades, especially using our confirmation signals here, right? So now in the case of gold, let's go to the same 7 to 8 a.m. hour. We see in the case of gold, we did get a breach of our aggressive volatility box entry line, and then we had our confirmation signal as we had this green arrow plot right here, right? So this was also a trade that triggered. We were now looking for an entry to go long at our volatility box entry line, which came as price action fell after we got that edge signal. So at this point, we're in a short on the NASDAQ along with a long in gold. Now, that short in the NASDAQ did get stopped out, right? Right here as price breached outside of the volatility box clouds. That was where we got stopped out. Now in gold, however, you can see gold had a really nice rally from our entry point. And this is where I come back to the second and third observations we made from our video, which is that gold has been a market that's better at predicting the reversals. And gold has been a better market to trade in terms of volatility that's contained, respecting our models, and price is reacting where we expect it to react, versus in the case of the NASDAQ, while we're breaching these levels, we're exhausting for a short amount of time before ultimately ripping up higher, right? And so that's the idea. It's being able to say, also be in the NASDAQ, but also be in the gold futures market, where our gold winner ends up hitting both our T1 and our T2, versus in the case of the NASDAQ, that first loser is based off of 2 T1s, right? And so automatically, and in this particular case of gold, this was about a $400 risk, a 4-point stop, and that made that trade all the nicer in terms of the payout. Now, if we keep scrolling in the S&P, you did have a very quick opportunity to short. We didn't get filled here, neither Cody nor myself. But if you say did have your orders parked ahead of time in this case, and you happen to have gotten filled, then that was a nice entry, which gave you not only your T1, but also a very nice T2. You did have another opportunity to come back and re-enter, but for me on a Friday, and this is really just afternoon time onwards, that's not when I'm looking at a new entry, and this was just a really sharp, quick, it hit the entry line. If you had your entry parked and your order got filled, fantastic. You had a really nice payout really quickly. But that was the end of Friday's trading. Now, if we pull back to Thursday And once again, start with our aggressive volatility box. We'll repeat that test in the morning just to make sure everyone understands it. We draw our line at 7 a.m. Pacific, and we check to see whether or not we've breached either side's aggressive volatility box entry line. You can see that we had here, but we also bounced from there. And that is your okay permission to continue to use the aggressive volatility box. And going through the rest of the day, in the case of the S&P, if we keep scrolling, we didn't have any entries, right? And now if I do the same exercise on the Nasdaq, if we scroll back, you should notice something very similar, except in the case of the Nasdaq, if we draw that same first hour test, and this is continuing that whole Nas-crack idea, we had our volatility box breached towards the end of the hour, and we had only a small follow through before price ultimately ended up ripping higher and stopping out what would have been a potential trade there if that wasn't the first hour of trading. Right, so that was interesting, and that was also a precursor of the volatility to come in the Nasdaq futures market. But once again, no other trades that triggered there. And if we go back to the Dow is a slightly different story, which was in the morning hours, the Dow gave us a very clear indication that this was going to be the more volatile market out of our three for the remainder of the day, right? We breached outside of even our aggressive volatility box clouds versus in both the S&P and the Nasdaq's case, we bounced from our entry line. And so this is our first hint, and that was our sign to switch on over to our conservative volatility box, which if we load that in, we can see that this model is capturing the volatility in the NASDAQ much, much better. And now if we keep scrolling through using our conservative model, no other trades for the rest of the day. And then we'll take a look at the Russell as well. The Russell bounced once again from our entry line, giving us that permission to continue to use the aggressive models. And the Russell did once again give you another opportunity to short right here, but that was a very quick trade, very similar to the S&P trade as well. And especially with the current volatility that we've seen in the indices, I've stopped parking my orders right away. So this is one where it took off without me, but ended up being a really nice reversal if you did still continue to park your orders despite the volatility that's currently in the marketplace. Okay, and then we'll load up gold and repeat the same idea just to show you it was a very similar day on Thursday as well. In the case of gold, where we didn't have any real opportunities to short either side of the market, go long any side of the market. And so our only activity came into after hours. And this is if you're still using the aggressive volatility box, but you then had an opportunity to short gold, which gave you a nice follow through, which we can see right here, right? What ended up happening from the actual point of entry all the way down to then a subsequent long entry. But again, both of these are on the aggressive volatility box. But the way I justify being a little bit more aggressive on trades during after hours, if you are looking to be more aggressive, is layering on something like the edge signal confirmation and recognizing that, yes, you are being a little bit more aggressive, especially during after hours. But the sort of benefit there is also our volatility box ranges are a little bit smaller, which also means less risk on each trade, right? So there's that trade-off. One way to justify it. But anyways, hope this video helped. Hope bringing up the previous observations, but talking about them coming through once again, helps paint an idea of how you can use some of these observations, how you can use the gold market to help you time reversals, and how you can also just look at the gold market as the safer, more contained volatility if you are looking to trade something outside of just the indices. All right, hopefully this video helps. Take care, everyone, and we'll see you in the next update.